Alright, it's me, Alex, and I'm here with another tutorial on Forex and quantitative finance. So this is going to be an overview of an indice for FX, and the indice will allow you to benchmark the performances of your systems or strategies or just discretionary trading performance. So I'm going to just go over really quick. It's published by Deutsche Bank, and it's available on DBIQ, which is a website that has a bunch of indexes for various markets, not just FX, but they have three components in this index. And the index is DBCR, the DBCR, Deutsche Bank Currency Return Index. So the three components really are how they break down strategies. So they break down FX strategies into three categories: carry, momentum, and value. So carry is just a carry trade. It is borrowing in one currency and lending in another, while momentum is just forecasting a trend based on past trends. And value is, just as it sounds, it's a fundamental, trying to find what the fair price is of the currency based on the value of the value of the currency. And it does this through inflation, and it uses inflation to model what's known as purchasing power parity, or PPP for short. If you want to learn more about purchasing power parity, I would recommend looking up a economics tutorial or economics lecture on it. However, all you really need to know for now, if you don't know what purchasing power parity is that it uses inflation and the cost of goods and living in order to estimate the value of a specific currency pair, so what the price should be. And if the price is not at that fair value, it will go back to that fair price. So their value strategy here is, in some senses, a mean reversion strategy. So it's a little bit different, but anyways, I'll continue. So they have the three strategies charted here, where light blue is carry, orange is momentum, green is value, and the blue, dark blue, is all three combined together with an equal 33% rate weighting. So I'll show you an updated chart, since this one only goes up to 2008. But something you might notice here about momentum and carry is that momentum goes for long periods of time with very little gains, and then suddenly it'll just soar. And carry is sort of the opposite. It'll go long periods of time with consistent gains, and then it'll just suddenly plummet. And the best explanation for carry plummeting and trending is due to the commodities market. A lot of the currencies that go long through this indice are commodity currencies. And if there's a recession or even economic instability, commodities are going to fall. And in turn, commodity currencies, which often have higher interest rates, will fall as well. So it's this indice sort of overviews why it's important to use a mix of various methods in your trading. But nonetheless, if you want to benchmark a particular strategy, like if you are just doing a carry trade, or you're just a fundamental trader, or you're just a technical or trend trader, then you would want to compare to a specific indice rather than the DBCR as a whole. And it just is because different strategies will have different correlations and they'll have different performances in comparison to one another. So it's generally best to compare to a specific strategy. Now, value, if you're doing stat arb, a lot of stat arb strategies would classify better under value. However, it may be a combination of the two, and you may want to weight the strategies yourself to benchmark. If your trading is, say, 75% technical or 75% trend trading, 25% fundamentals, then you may want to do that as your weighting in order to determine how good your performance should be. So I'm going to just continue on to how these indices are constructed. So the main three indices, they're based on the G10 pairs, and these here are G10 currencies. So the carry index is probably the simplest. Now it rebalances every 3 months, and it creates through this universe of G10 currencies. So whatever your currency universe you have constructed is, it'll rate the 3-month LIBOR. Now the problem with going by 3-month LIBOR if you're a retail trader is LIBOR isn't that easily accessible to FX traders. So an alternative would be short-term government securities. So instead of a 3-month LIBOR, you may want to go with 3-month treasuries or 3-month German bunds or what all. Or if you're feeling cunning, then go ahead and try with a corporate debt on a slightly longer term. But I'm not advising for you to invest in any of these indices, just for how you want to benchmark it. Now, Deutsche Bank currency momentum. So the next one is momentum, and it rebalances every month. This is just because trends can change for currencies quite rapidly. So within the 10 currency universe of the G10 pairs, you want to rank each currency against the US dollar in its 12-month return. So from the best performance to the worst performance. And you want to select the 3 best currencies and the 3 worst and match them together. So by matching them together, you're taking the strongest and the weakest for the year, putting them together, and you're betting the trend will continue on those currencies. So it takes 33% allocation to each of the currencies. So now to the value indice. This one has it's a slightly longer rebalancing. It's also 3 months, just like the carry. And it ranks each universe in the currency universe each currency in the universe you construct by its biggest differential between the purchasing power parity and the actual value. So let's say that the dollar Japanese yen, let's say it's trading at 150 right now. And let's say that the purchasing power parity fair value is 135. So let's say that's the biggest differential of all the 10 currencies. So you would want to bet the USD JPY would fall in that case, if that was one of the 3 largest. So you would be taking the differential and them ranked by the top 3. So the purchasing power parity they go by for their benchmark is the Organization for Economic Cooperation and Development. I think that's what the OECD stands for. I'd have to look that up real quick. OECD. Let's see, just to verify, I don't want to look. Yeah. Organization for Economic Cooperation and Development. All right, yeah, I was right. Okay. So anyways, you want to take the 3 most overvalued and most undervalued currencies, match them together, and you'll be betting that those currencies will go back to their fair value. And you want to do this every 3 months based on this index. So if you're wanting to replicate this index, you'd want to do that every 3 months because that's the rebalancing. Now, you don't have to really replicate it since Deutsche Bank has already done that for you, and they even have it so you can export it to Excel if you want to create a weighted index to match your own performance. Like another example of a weighted index you may want to use is if you're holding for swap, but you also try to forecast trends in currency, you may want to benchmark both the carry and the momentum, depending on how much you would consider your own ratio of the methods to be. Anyways. So now let's look at the next thing that's really interesting about FX, and it shows you not only what is a good, so it doesn't show you what a good return is, but it shows you what a good correlation / what you could use to check your beta. So a good correlation to equities is basically uncorrelated. You don't want any correlation to equities really, because 5% is 0.05. Even the correlation to the US dollar is 0.12, basically none. The commodity market, basically none. Interest rates, basically none, for the DBCR that is. And just to go back to the Sharpe ratio, I don't think I went over this, but if you're looking to compare your Sharpe ratio of a passive strategy, then you're going to want to benchmark to these values. So if you're only carry trade, if you're only a carry trader, you're going to want a Sharpe ratio of 0.29. That's what they have between 1989 and 2009. And it shows for the other strategies the Sharpe ratio you should have. And I'll show in a second the more updated performances. And that's on the DBIQ website that Deutsche Bank has. And it just shows the various indices, anyways, in real time. So this is the other versions of the index for the DBCR. The DBCR Plus is really just including emerging market currencies. And by including these emerging market currencies, it consistently performs better. So if we look at the blue line here, light blue, compared to the dark blue, the Sharpe ratio is almost twice as good if you include emerging market currencies. Twice as good. That means twice as good performance. Now the return figure isn't as good, but the risk is about the same. So it really is a whole lot better. Look at the annualized volatility. Now the DBCR dynamic index is using filters to determine whether a strategy should even be applied. So if you're an active management investor, you'll probably want to benchmark to the DBCR dynamic. And if you look at the DBCR dynamic, there's periods of time where no performance is done. No trades are done. It just is this straight line here. Nothing. So that's showing that, as you can see, it sometimes will completely exit the market if none of the filters are met. So just looking at the filters, the carry filter applies a momentum filter to forecast returns. And this is because if we go back to the carry index, it goes long trends for long periods of time, and then it'll plummet. And really what this momentum filter they apply does is it well, they call it the carry filter, but it forecasts future returns using momentum. For this reason, a momentum filter makes the most sense, allowing the DBCR dynamic to remain invested in carry while it's performing and to reduce its exposure during underperformance. So it does try to forecast the trend when there is severe underperformance and plummeting in returns. The momentum filter, they describe it as a mean reversion, but that's because momentum, going back to the charts again, momentum, as you can see, will go very flat for a long period of time. So it takes profit by selling when the trend skyrockets, when returns skyrocket on momentum, and then it re-enters when there is a lengthy period of trending or no trend in prices. So you would want to benchmark to the DBCR dynamic filters instead if you're looking to benchmark your returns for active management. Now let's go back to value. So the value filter applies a similar technique. It's still a mean reversion filter, and it just has the taking of profit, just like the momentum filter has. It's a bit of oxymoron to call it a momentum filter because it's actually a mean reversion filter applied to momentum. So anyways, these filters, when applied, also improve performance. Now let me go back to check, because I don't think these filters use the emerging markets. I don't think so. So I don't know what the return would be if you added a combination between the DBCR Plus and DBCR Dynamic, just combining them together using both emerging markets and the active management filtering. I could assume it would be much better. Now, that's just what I'm assuming, but that's based on the observation that the DBCR was doubled in its return, risk-adjusted return, just by applying the filter. And returns on DBCR Dynamic, which has active weightings, was increased dramatically as well. Anyways, so let's go look at the most recent performances of the DBCR Plus. So it's available on this website. They have all sorts of really great indices, and depending on if you're equities, fixed income, whatever, and it's all free. That's the best part, and it's not like they're doing it for profit. It's all ad free, so that's why I really like this. And they have all sorts of other FX indices if you want to check those out. So anyways, this is the DBCR Plus, combining all the indices together into the DBCR Plus. This is the return between 2000 and 2016 present day. So that's just as showing what the returns have been past 2008. So up here was about the cutoff before they published it. So there was a bit of drawdown. Anyways, so this is the value filter. I do believe, yeah, this is the value filter, which it has had, the performance recently has been pretty good. But if you look at the cutoff point right around here, this is the more recent performance. Then back to momentum. Now, momentum is probably the worst as far as consistency in returns. There's these really large periods of just perfect performance, but then drawdown really kills it. So anyways, carry, this is the carry's performance, and it has recently not done too hot, mostly due to underperformance in global commodities. Now, let's go back to, here's the various indices, and you can export the data to Excel if you use Excel, and you could do weightings or comparing your own performance real time to how the various indices performed. So anyways, I'm gonna call this video quits. I'm gonna have all these links in the description if you want to check these out. Anyways, thanks for watching. If you like this video, give it a thumbs up. If you want to see future content, go ahead and subscribe. And I'm just in the video.